This is CPA Berkeley video series. Today we are going to discuss Unit 1 for BEC, that is Corporate Governance. Broadly, we are going to discuss the topics like role in the governance hierarchy, internal control, and in the last we are going to discuss the enterprise risk management. First of all, we are going to discuss what is a corporate governance. Governance is the set of policies, procedures, and processes which helps ensure that organizations are operating efficiently and effectively. There is a strong emphasis on the corporate governance or the listed companies because of the poor management seen in the past few years. Certain laws has been introduced like Sarbanes-Oxley, which emphasize and clarify the roles of governance and sets the benchmark for the directors today, that what is the structure for a corporate governance. We will discuss how the board of directors work. We will see the role of SEC, that is Security Exchange Commission, and its regulatory or monetary control over the companies. We will see the role of Audit Committee. We will discuss that Audit Committee has the NEDs, non-executive directors, it has internal auditor, it has external auditor. So it brings the neutrality and efficiency in the operations, and it helps organizations to grow and bring good performance in the business operations. Then every organization is headed by the management, and the CEO is taking the lead to run the show of the day-to-day operations. Then we have certain employees in the company who have different roles in performing and bringing good results for the organization. What are the stakeholders? Stakeholders are those people who are interested in any capacity in the organization. They have some stakes, they have some interest in the organization. Being a part of a corporate governance, we should be focusing on our stakeholders, and shareholders has invested in the company, and they are the main stakeholders for the organization. We have to protect their interest. We have to try to maximize the shareholder wealth. And along with this, we have to see the other stakeholder like payables, receivables, bank, government, other regulatory authorities. We are protecting their interest, and we are not in the violation of anything. So stakeholder are the person or entities which are affected by the activities of the entity. In general, these are employees, supplier, customers, neighbors of the entity, facilities, and the government regulators. Corporate governance mechanism can either be internal or it can be external. Then what are the basic corporate documents which are required? Generally you need a certificate of incorporation so you can operate with the legal openness in the operations. Certain companies are formed under federal law, which are very less, but generally the companies comes into being with the article of incorporation are filed with the Secretary of the State. It may have the memorandum of association, and it has an article of association which is explaining the purpose of the corporation. The name of the corporation will be here, what are the authorized share capital, then street address of the corporation, and then the name of the registered agent and name and address of the each incorporators. Then the article also may contain optional provisions like the purpose and power of the and powers of the corporation, then what is the internal management, how it will work, what is the procedure, policies, any subject required to or allowed to be addressed in the bylaws. What is bylaws? Bylaws are the sets out the rules for a corporation, highest level of governance, that how the company will run, it will be set in the article of association. Then shareholders are those people who have invested their money in the company, ideally or primarily these are the owner of the company who works through the board of directors, and the common shareholder are those who have contributed to the basic capital for the corporation to carry out its business. Then generally shareholders are permitted to act only at a meeting. If you are a shareholder who has the ordinary shares, surely you have a right to vote and you have a right to select your board of directors who will protect your interest, and they will have the meetings with the management and they will see the operational efficiency of the company and they will try to maximize your wealth. Board of director is responsible for the strategic vision of the company. They take strategic decisions, they set the vision and they set the targets and they set the merger and acquisitions option, and broadly their work is more into a strategic operations in terms the management is looking for the day-to-day operations. So all major corporate decisions are made or approved by the board itself. Then board generally involved in the selection of and removal of the officers. Then decisions about capital structure, how much would be the optimized structure, what would be the debts, what should be the capital amount. Then we will see the board is for the adding, amending and the repealing by laws, and the authority is reserved to the shareholder, and surely board is responsible for the fundamental changes like mergers and acquisitions, and board has to declare a dividend to the shareholder. It may be an interim dividend, it may be a final dividend after 1 year. Then setting of management compensation, sometime performed by a subcommittee called the compensation committee. Then board has to coordinate the audit activities with the audit committee, in which we have the external auditor, non-executive directors, and internal auditor is also there, evaluating and managing risk, sometimes called by the risk committee. And director and officer own a fiduciary duty to the corporations. Generally in the past, directors were found involved investing by their own will, obliging their own related and connected persons, and it could cause corporations suffer a great loss. When it came into a regulation and we saw this Sarbanes-Oxley regulations, then things were being cleared out and it is more organized now. Every director has a fiduciary duty. They have to act in the good faith, and it requires the directors to work in the best interest of the corporation, removing any conflict of interest which can damage their decision, reputation. Then they should be loyal, they should use due diligence, which is very much required as a strategic vision and for taking the right decisions. Then if there is any conflict of interest, you have to disclose. Controlling or majority shareholder own similar duties, and then the Sarbanes-Oxley Act 2002 generally prohibits personal loans to executive or the director of the public company. The business segment rules protects an officer or a director from personal liability for the honest mistakes of judgments. We understand that directors are also human beings and they can have a mistake in the judgment or for any investment or for any opportunities they go for. Surely if they are loyal, if they are faithful and they are working in the best interest of the company, they are not being personally liable for their acts. So if they are in good faith, was not motivated by fraud, conflict of interest or illegality, and was not grossly negligent, and to avoid any personal liability, director and officer must make informed decisions, educate themselves about the issues, be free from the conflict of interest, and have a rational basis to support their positions. Officers, generally the board is the working board of directors is looking for the overall strategic objects and interest, and the company is run by the management. Day-to-day operations are there. There is a CEO who is running the show of the company, and the chief executive officer is directly selected and reported to the board of directors, and then CEO interns usually select C-level employees. One is the chief financial officer and the other is CIO, that is chief information officer. Internal audit function is a core element for any corporate governance, which brings efficiency. It enhances and bring value additions in the business operations, safeguard your assets, and bring adherence to the management policies, and then it helps to identify the risk, and it introduces and apply and implement the risk management techniques, and it increases the credibility of the organization operations. An internal audit function is crucial to the governance, and it's mandatory also. As a part of the definition of internal auditing, the Institute of Internal Auditor (IIA) says that it helps an organization accomplish its objectives by learning a systematic, disciplined approach, and to evaluate and improve the effectiveness of the risk management, control and governance. So shortly, this is RCG, that is risk, control and governance. The work performed by the internal function can be divided into two categories. One is the assurance services, one is the consulting services. For consulting services, generally the internal audit manual will clarify the scope of the assignments, whether it's allowed to the internal auditor to take for a specific engagement or they cannot. So according to the manual and the charter, everything should be defined to make things clarified for the organization.